Okay, so right now, there's this really powerful and honestly kind of confusing signal coming from the financial markets. On one hand, we've got a major global threat, but on the other, we have a market reaction that seems to make absolutely no sense. So let's dive in and break down what's really going on. So, the story really kicks off with a major geopolitical threat. What's happening is the Iranian regime just announced they might try to cut off the Strait of Hormuz. And you have to understand, this strait is like one of the most critical arteries for the entire global economy. And at the heart of all this is one number: 20 million. I mean, it's a huge figure, right? But what does it actually stand for? We're talking 20 million barrels of oil every single day, squeezing through this tiny choke point. I mean, if that gets shut down, that would be a massive, massive shock to the world's energy supply. The consequences would be immediate and, frankly, huge. Now, if you pull out any economics textbook, Econ 101 stuff, a threat like this is supposed to set off a very predictable chain reaction. It's a classic case of cause and effect. So let's just walk through the dominoes here. Step one, you get a supply shock, right? All that oil just vanishes from the market. That would send oil prices spiking, maybe to over $110 a barrel. Then, higher energy costs mean everything gets more expensive. So, boom, inflation rises. And when investors see inflation coming, what do? They sell off bonds. Pretty simple, right? And listen, we're not just talking about a little bump here. This kind of shock could easily rocket inflation up to 4, maybe even 5%. And that's a huge deal for the economy and for you, for me, for every single consumer. So here's the key takeaway. Think about it. If you know inflation is about to eat away at your money, why would you hold a bond that pays a fixed, lower interest rate? It's a guaranteed losing game. The value of your investment gets eroded. The only logical thing to do is sell. But this is where the story takes a really weird turn. Because everything the textbook says should be happening, well, it's just not. In fact, the market is telling us something completely, totally different. And this really brings us to the core puzzle of this whole thing. What on earth is the US bond market, which, by the way, people often call the smart money, what are they actually doing with this huge inflation threat hanging over our heads? And this just lays out the contradiction perfectly. I mean, the logical, rational thing to do would be to sell bonds, right? But what's actually happening? Investors are out there buying long-term US government bonds. They're doing the exact opposite of what everyone would expect. So yeah, this is a huge puzzle. Usually when the market acts this illogically, it means there's a deeper story that most of us are missing. So let's try to play detective here and decode what the bond market is really trying to signal. Okay, so the first and most obvious explanation you're going to hear is, oh, it's just a classic flight to safety. Whenever things get scary in the world, investors dump their risky stuff and run to the safest assets they can find. And for decades, US government bonds have been the ultimate safe haven, the go-to place to park your money when things get chaotic. But does that explanation actually make sense right now? Yeah, here's the big problem with that whole theory. Sure, the bond is safe in the sense that the government won't default on it, but it's totally exposed to inflation. If inflation jumps to 4 or 5%, holding that safe asset is a guaranteed way to lose purchasing power. It doesn't add up. So this pushes us towards a much more interesting idea. The fact that they're acting so counterintuitively suggests that the big players, the pros in the bond market, are working off a completely different playbook. It's like they're seeing a totally different future than the one we're all reading about in the headlines. So, okay, if it's not just a simple flight to safety, then what is it? Well, it looks like it's a very specific and honestly a very surprising bet on where the economy is headed. So what this tells us is that this isn't an act of fear. It's not a panic move. It's a calculated, strategic investment. This is a cold, hard prediction about what's just around the corner. And here's what that bet is, plain and simple. The investors who are buying up bonds right now, they're wagering that despite all the scary headlines, oil prices are not going to surge. They're betting that the biggest economic story on the horizon isn't inflation, it's disinflation, a major slowdown in how fast prices are rising. So what we've ended up with are two completely opposite stories fighting it out to define our economic future. And believe me, the outcome here has massive implications for absolutely everyone. So it all boils down to this. In one corner, you've got the headline story. A huge geopolitical crisis is about to make inflation explode. And in the other corner, you have this quiet but powerful story being whispered by the bond market that the economy is actually cooling off, and the real thing to worry about is prices slowing down. And so that leaves us with the million-dollar question, doesn't it? In this massive showdown between the screaming headlines and the quiet confidence of the so-called smart money, who's right? Because the answer to that question is going to shape everything for the global economy in the coming months.